I'm going to use exercise 5.3 just to review a couple of the items that we covered in the overview of the chapter. I'm going to start with what the question is asking. So it's telling you that Harris Fabrics computes its predetermined overhead rate annually on a basis of direct labor hours. It goes on to tell you that at the beginning of the year it was estimated that overhead would be $134,000 and that the hours worked from a direct labor standpoint were 20,000 hours. So what are those two things telling us? If we start with the dollars, $134,000 will include everything that is not direct materials and direct labor that's attributed to this company overall. So the cost of salaries for its leadership team, the cost of rent or maintenance on the building overall are a couple examples. The direct labor hours of 20,000 hours are telling you that it expects that it's going to take 20,000 hours of staff time to produce whatever product or service it is that they produce, and that's an estimate at the beginning of the year. Hopefully you recognize that the actual information that was given to you for purposes of this assignment were originally not needed, but we're going to use them in a minute. Let's first calculate our predetermined overhead rate. The formula, as you'll recall from your book, is to take your manufacturing overhead dollars and divide it by whatever your allocation base is. And in this case, they told us that the base is direct labor hours. So we're going to divide it by the estimate of our direct labor hours. So we're going to take $134,000 divided by 20,000 hours, and we're going to calculate that. For every direct labor hour worked, we're going to burden that hour with an additional cost of $6.70. What does that mean? If you work to produce a product and you're paid $10 an hour, we're going to charge your hours at $10 an hour plus an overhead rate of $6.70 for every hour that you work. That's how you can interpret this information. Why does that matter? Why does that make sense? Again, it's an attempt to get every cost associated with running a business down at the unit level. This is full absorption costing. Once you get to the end of the year and you actually know how many hours you worked and how many dollars you spent, it's necessary from a cost accounting method to figure out whether or not you've under or over applied. And the steps that you go through is to first figure out how much manufacturing overhead has been applied. That's going to be based on a calculation of actual hours multiplied by your predetermined rate. The problem gave us actual hours. It said the hours worked were 21,000 instead of the estimate of 20. So we're going to take 21,000 and we're going to multiply that by $6.70. And again, what is that number? The calculation comes out to $140,700. But what does that number mean? It means that in our financial statements, since we charged 21,000 hours and we charged those 21,000 hours at a rate of $6.70 an hour, we have overcharged to our cost of goods sold how much our overhead should be. And we can tell that quite simply because on a unit by unit basis we booked in our financial statements $140,700, but we know how much we paid our employees and how much we paid for rent and how much we paid for maintenance, and we actually paid $123,900. So we have over applied our overhead rate. Our per hour rate was too high because our estimate was off. Why was our estimate off? We underestimated the number of hours, we overestimated what the cost to our company were going to be. That combination means that we have over applied our overhead rate. And the way you calculate that is to take how much you've applied and you're going to subtract what you actually spent. And we're going to make an adjustment to cost of goods sold based on that number. We'll do that in a separate problem. If you have any questions on this, please send me an email or post a question in Moodle and I will respond to everyone in the class. Thanks so much, and we will do problem or exercise 5-4 in a separate video.